STAG Industrial Stock, ticker symbol STAG. Is this the best REIT to buy right now? STAG is down almost 16% on the 1-year chart, which is quite the difference with the overall market. The S&P 500 is down 8%. On the 27th of October, STAG Industrial presented quarterly results where they beat both on FFO and revenue by a small margin. For the upcoming earnings presented on the 15th of February, there's a mixed feeling among the analysts. The reason why people love STAG Industrial is because of the monthly dividends. Instead of a dividend once a quarter, you will receive a small dividend every month. Dividend yield sits roughly at 4.3% and have grown the dividends for more than 11 years in a row. But does this mean that STAG stock is a buy at current prices? Well, in this video I'm going to show you real quickly what STAG Industrial does, the most recent earnings, the fundamental analysis, dividends, and in the last part I'm giving you my price target to see if they are a buy or not. And I think you definitely want to see that part, so make sure to watch until the end. And I'm also very excited to see what you guys think about this stock, so please let me know your thoughts in the comments. My name is Thomas and this is Thomas Invest. I'm an investor looking for great stocks at great prices. So, what does STAG do? STAG Industrial is a real estate investment trust primarily involved in the acquisition and operation of single-tenant industrial properties throughout the United States. The vast majority of the company's real estate portfolio is comprised of warehouse and distribution buildings. If we dive in the most recent earnings report, we see that STAG reported 0.35 net income per basic share compared to 0.3 last year, same quarter. So they got a steady increase there. They achieved 0.57 of core FFO per diluted share for the third quarter of 2022, an increase of 7.5% year over year. NOI increased more than 18%, which is something that I really like. The industrial US market is more than 1 trillion in total size. The current market share of STAG is just below 1%, so there's plenty of room to grow. STAG has a portfolio widely diversified across geo, tenant, industry and lease term. They have more than 60 markets within their portfolio and their largest market exposure is less than 8% of the ABR, which looks pretty good to me. The largest tenant is only 3% of the ABR. The top 20 tenants have a share of less than 20% of the total ABR. And we see that the vast majority is a 1 billion revenue company or bigger. As I said earlier, the largest tenant is only 3%, which is Amazon. After that, the second largest tenant is only 0.9% in ABR. And now that we know more about this company, it's time to check the fundamentals of this stock. But first, if you made it this far into the video, I want to thank you a lot for watching this video. Make sure to subscribe and in return you receive similar analysis to this one every week. Let's continue by diving into the fundamentals. STAG Industrial is a 6 billion market cap company with a PE ratio of 25. But since this is a REIT, I don't want to focus on the PE ratio but use the price to FFO. Price to FFO is at 16.2, which is right around my preferred number of 16. So this could indicate that STAG is fairly valued right now. Later in this video I will show you my 3 price targets for STAG Industrial, so make sure to watch until the end, since price to FFO is only telling a small part of the full story here. Revenue is at 634 million, and in this graph we see that revenue is going up really nice and steady, which is something that I really like of course. Over a longer period of time we see that margins are going up, which is of course something that I like as well. EPS is also going up in the past couple of years, so this is also looking really good to me. Analysts expect EPS to decrease quite a bit in the coming years, which kinda surprises me based on what we just saw a second ago. And it's the same story with the revenue, but okay, we have to keep it in mind. Return on asset is sitting at 2.5%, which is the average for a REIT, and it's the same story with return on equity. Return on invested capital, the most important number here, is at 2.1%, which is kinda low, even for a REIT. I really like it when the current ROIC is higher than the 5-year average, so this is also looking good. Current ratio is at 1, which is right around my preferred number. On top of that, I really like it when it goes down, as it did most recently. And another thing to keep your eye on is the total debt and total cash. I prefer companies who can pay down at least a third of the total debt with the total cash. Right now total cash is at 19 million, while debt is at 2.5 billion. So it's very important that free cash flow is growing, since this is used to pay down debt, do acquisitions, buy back shares and a lot of things. In here we see that free cash flow has grown quite a lot in the past couple of years, and it's also quite steady and consistent, so this is something that I really like. If we check the shares outstanding, we see that it's going up quite a lot in the past couple of years. Usually this is not a good sign, but REITs issue new shares to raise capital and grow the business, so I'm not worried that much about this number. Next up are the dividends. Dividend yield is sitting at 4.26%, which is a really good number in my opinion. Annual payout is at $1.47, and since this is a monthly paying dividend stock, you will receive $0.12 each month. The payout ratio displayed here isn't correct. Based on the FFO, which REITs use to pay dividends, the payout ratio is around 63%, which is pretty good for a REIT, so this looks quite good to me. The 5-year average growth rate of the dividends is at almost 1%, which is not that high, but I'm okay with that since they grew the dividends for 11 years in a row, which is quite impressive, and it's already at 4%. But does this mean that STAG Industrial is a buy at current prices? Well, let's check the 3 price targets that I created using the Everything Money software, which is one of the best tools out there. I'm using a low, mid and high assumption to get the 3 price targets, starting off with revenue growth. For the revenue growth I'm filling in 9% because of the historical averages. For the mid assumption I'm filling in 11%, and for the high assumption I'm filling in 13%. For the profit margin I'm filling in 32, 37 and 42%. For the free cash flow margin I'm filling in 34, 37 and 40%. PE ratio is not the correct metric to use for a REIT, but we have to fill it in, so I'm putting in 20. For the price to free cash flow I'm putting in 16, 17 and 18. My desired annual return is 12.5% since I can get an easy 10% average annual return with owning an ETF. Right now STAG Industrial is at $35. I hit analyze and we see a few green numbers. I don't pay attention to the PE ratio since this isn't a great way to value a REIT, so I'm only focusing on the discounted cash flow value. We have a low price target of $24, which is a big drop from where they are right now. A mid price target of $31 to $32, which is right below the current stock price, and we have a high price target of $41. To me, the mid to high price target is the most justified here, since I expect growth to slow down just a little bit and the rest of the numbers to stay at current levels. That would mean that they are right in the middle of these 2 price targets. My final conclusion is that I really like this company. It's one of the largest REITs positions in my portfolio, and with reason. They are very steady and consistent, and as we saw in the earnings report, they only have a 0.7% market share, meaning there's enough room to grow the business. Dividends also look really nice and brings in a decent amount of money every month. The valuation is okay. Right now they are in the middle of my mid and high price target. I expect that it will slowly increase my position throughout 2023 and keep collecting the dividends. But remember to always do your own research and never fully trust on what I or other YouTubers say about a stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.